All right, today we're going to get into something really fascinating. The idea that when it comes to money, your behavior is way more important than how smart you are. Seriously, we're going to unpack the key mindsets that actually build wealth, and it all kicks off with a story you probably won't believe. Let's dive in. Okay, look at that number, $8 million. What's the first thing that pops into your head? A lottery jackpot? Maybe a tech founder who just sold their company? Yeah, maybe you're thinking this has to be the nest egg of some high-powered Wall Street exec, right? Someone with a fancy MBA who's basically a human spreadsheet, living and breathing the markets. I mean, that's the logical guess. But you'd be wrong. That $8 million fortune, it belonged to a guy named Ronald Reed. He was a rural janitor from Vermont. And no, he didn't win the lottery, he didn't get some massive inheritance, so how on earth did he pull it off? Well, Ronald Reed's secret wasn't really a secret at all. It was just patience. That's it. He saved what little he could, consistently, and he invested it in big, stable, blue chip stocks. And then he just waited for decades. He let the magic of compounding do its thing. His story is the perfect example of the big idea we're talking about today. And this quote from Morgan Housel's book, The Psychology of Money, just nails it. Financial success is a soft skill, where how you behave is more important than what you know. It's not about complex math, you see. It's about getting a handle on a few key behaviors. So let's break down the first one. We all want our investments to do great, obviously. But here's the thing we always forget. Those big returns aren't free. There is a price you have to pay. And that price is dealing with volatility, uncertainty, and frankly, fear. It's not a fine you get for making a mistake, it's the cost of admission to the show. Think of it this way. You want a nice watch, you walk into a store. You have two options, pay the price on the tag or try to steal it. We all know you gotta pay the price. Well, in investing, the market going down is that price. You have to be willing to endure the dips to get the long-term reward. Trying to get the gains without the pain is like trying to steal the watch, and that usually doesn't end well. Let's make this super real for a second. Imagine you were a genius and saw Netflix's potential way back when. Awesome, but could you have handled this? In 2011, the stock dropped 80%, 80, in just a few months. Your account would have looked like a disaster zone. Would you have freaked out and sold, or would you have been tough enough to pay that price and hold on for the incredible ride that came next? And listen, this isn't just for some crazy growth stock. Even with a safe investment like the S&P 500 index fund, you would have spent a combined 13 years since 1980 with your money down at least 20% from its peak. Think about that. That's a huge emotional price to pay, but it is the required cost for building real wealth in the market. Okay, on to the next major mental hurdle, this soul-crushing thing called social comparison. Capitalism is amazing at creating wealth, but man, it's just as good at creating envy. And that feeling of never enough is what pushes people to make some truly terrible decisions. See, the problem is, it's a ladder with no top. The doctor making 500 grand a year feels pretty good until they buy a house next to a CEO making 10 million. And that CEO feels rich until they're on a yacht with their friend Michael Jordan, who's a billionaire. But even MJ might feel a little small at a party with Jeff Bezos. The ceiling just keeps going up and up. There's always a bigger fish. So what do? You have to know when to stop moving the goalposts. This role right here is your best defense. The absolute hardest financial skill is getting those goalposts to stop moving. Risking things you actually need, like your reputation, your freedom, your family, all for extra money you don't need, well, that's just a fool's game. All right, this next idea is a real mind bender. We see other people making financial choices all the time, and we think, what are they doing? That's insane. But here's the thing. What looks crazy to you might make perfect sense to someone else, all because of their own unique life experiences. Take this, for example. The lowest income households in America spend, on average, over $400 a year on lottery tickets. That's 4 times more than the highest income group. For some of those folks, that's their entire emergency savings. So looking at that from the outside, it seems totally irrational, right? I mean, statistically, it's an awful investment. But before we jump to conclusions, let's just try to see it from their side for a second. Look, if you have very little room to save and fewer opportunities, putting away a few bucks a week isn't going to change your life. It's not buying you a house. But a lottery ticket, that's buying a tangible dream. It's a shot, however small, at the life you see other people living every day. And suddenly that crazy decision starts to make a little more sense. It's a powerful reminder that our financial views are shaped by our own personal history. This brings us to a really important point. The world is wildly unpredictable. History is just one surprise after another. So instead of trying to guess what the next big crisis will be, the smarter behavior is to just accept that you can't predict it and prepare accordingly. The author Nassim Taleb calls these unpredictable events black swans. Think about the 2008 financial crisis or the COVID pandemic. Nobody saw them coming. They were extreme outliers with a massive impact, and of course, after the fact, everyone has a theory about why they were inevitable. The key isn't predicting them, it's being durable enough to survive them when they show up. And here's why being durable is so critical. If you'd put money in the S&P 500 20 years ago and just held on through the dot-com bust, 2008, COVID, all of it, you would have earned a 291% return. Not bad. But now look at this. If you got scared, tried to time the market, jumped in and out, and you missed just the 4 best days over those entire 2 decades, your return gets slashed almost in half, down to 164%. Trying to predict the unpredictable is a losing game. The winning behavior is simply staying in the game. So why is it so hard to just stay the course? Well, it turns out our brains are basically hardwired to find bad news way more interesting than good news. There's a reason pessimism is so seductive. Why does this happen? Well, pessimism sounds urgent. It sounds smart. When someone predicts doom, it grabs our attention because it feels like an immediate threat we need to deal with. But optimism is the quiet belief that things will generally get better over a long, long time. It's a slow, boring story, and it can sound really naive compared to the sharp, dramatic story of a coming collapse. And you know what? There's a deep, evolutionary reason for this. As the Nobel Prize winner Daniel Kahneman explains, for our ancestors out on the savannah, treating the threat of a nearby lion as way more urgent than the opportunity to find some berries, well, that was a pretty good way to stay alive. That survival instinct is still baked into our brains. We are designed to pay more attention to bad news. And so we've come full circle. From the janitor who showed us that patience is more powerful than a PhD, to all the psychological traps that are waiting to derail us. We've seen that building wealth isn't just about what you know, it's all about what you do. The best part is, you're in control of that. You can change your behavior. So I'll just leave you with this question. Knowing all this now, what's the one behavior you can start to change today?